All right, welcome back to the Investors Gate podcast. I am your host, Austin DeNoce, and today I'm going to be sharing my trading commandments. Trading is a very difficult thing, and if you don't have a solid set of rules or principles guiding you, it's going to be very difficult to be profitable. So today I'm just going to be sharing, outlining my personal trading commandments that have helped me and will hopefully help you. All right, let's do it. So my first rule is simple. Don't overtrade. This is something that traders have a very bad tendency to do because it's exciting. It's the emotional part of it. You want to make money. You want to make money quickly. But oftentimes, overtrading is the biggest mistake because say you trade 10 times a week and half of those are profitable, but you look back and you find out that all your high conviction ones were your only profitable ones that made up for all those other losers. If you were just more patient and didn't commit to all these extra trades, you'd actually be more profitable because you're really just adding losses. Some of the most profitable traders only trade a few times a week. They just trade when they find their setup, when they see something that looks good. That's the beauty of trading. You don't have to commit to every trade. There's a million trades out there. You'll hear that in a lot of chat rooms, people saying there's always another trade, and it's true. It's one of those platitudes that really makes sense because there's always another trade, there's always another stock moving up or down for you to make money off of, and there's no need to rush a bad setup or to overtrade because it can lead to you blowing up your account and your ultimate demise. So be patient. Let a trade prove itself to you. I think that's a huge lesson to be learned as you trade more. When you overcommit or you get excited, you get burned and you realize how bad it is and why it's so important to be selective with your trades and only trade what looks good and you believe will be profitable because it has a higher probability based off of whatever your other rules or your strategy is. So always keep that in mind when you are looking to enter a trade. Has it proved itself to you? There's no need to commit. Only take the highest probability ones you can. Even if it ends up being winner and you didn't get in, so what? The important thing is to not lose money. So be patient and wait for the best setups. All right, Commandment 2, trade with conviction. If you're going to enter a trade, enter it and commit to your stop loss, commit to your take profit or your levels. And so this will require a certain level of preparation to have that conviction. But if you don't have the conviction to enter a trade, don't. You need to commit to losing or commit to winning. When you half-ass these things, you get emotional, you get out when you shouldn't, or you stay in when you shouldn't. And this is partly related to just trading your plan. You have to have confidence in yourself, in your plan. Because if you have an edge, it's going to play out over the long term. If you don't, well, you should work on your plan, but then you probably shouldn't have any conviction or confidence if you don't have a plan that you believe works. If you see a trade that looks like it has the right setup based off your rules or strategy, take it. Don't hold back. Don't miss out. That's why it's important to have rules, because if a certain setup meets your standard for entering, you should do it. There's no reason not to. Trading with conviction is also hugely important for recognizing if your plan does or does not work. If you don't fully commit to your strategy or your plan, it's hard to tell if it is effective or profitable. Now, if you're developing a plan, I would either paper trade or commit with a very small position size, but still trade with conviction. It's the only way to find out if your plan or strategy works, and it's ideally how you want to trade in the future when you have a successful plan. Commandment number 3. Don't follow anyone else's trades. This is very hard when you're first starting out because you don't know anything, and that's how it is for everybody. But the tendency to enter these chat rooms or social groups to get calls or assistance is dangerous. You're constantly hearing people say not financial advice because there's a lot of money at stake and you don't want to just follow people blindly without knowing why it is they like the stock or whatever it is they're investing in. Because if you don't know the reasons you're entering, how can you know the reasons to exit if it goes south or something changes? Also, following people's trades isn't sustainable unless you really are learning a plan as you go and then you're able to apply that on an individual basis, you can't be codependent, or at least you shouldn't be with your trades. It just isn't sustainable. Relying on other people's advice or trying to follow them in trades is a great way to lose money. There's a lot of people who are very profitable in how they allocate money and invest, but their strategy just doesn't resonate with people enough to where their edge sticks with them. A huge part of trading is psychology, and if you don't understand why you're entering or why you would exit, it's going to toy with your emotions and your mind. Even if the person you're following is a very successful trader, it is very difficult to follow someone in uncertainty. And this is not to say you shouldn't learn from people or that people talking about their trades isn't helpful, but take everything with a grain of salt, because it can be dangerous to blindly follow people, and you definitely don't want that to be how you make your money or trade in the future. So just do your best to not follow anyone else's trades. Commandment number 4, size your positions based on your confidence in them. This is something people, for whatever reason, generally don't do. Maybe it's naturally you just want to weight everything in a similar way. Every position you enter, you're like, I want to do $1,000, or I want to do $100 or $10,000 for every position I go into. But every position isn't the same. And based on the setup or why you are entering it, it could seem to you that this is more likely to play out, or your risk is different, or your reward is different. And you should always try to size your positions accordingly, because oftentimes that is your edge. If you have more confidence in a play, why wouldn't you want to put more money down? Similarly, if you have low confidence in a play, why wouldn't you do a smaller position? Now, if you backtest your ideas and you see your higher or lower conviction entries work better or worse, this will make a lot more sense to you. You'll see that all these trades with this setup that you think are high probability tend to win more than they don't. In that case, why wouldn't you want to put more money on the table? Your position size is one of the greatest tools at your disposal. A lot of high-profile traders and investors will often say, if your conviction is through the roof, bet the house. If you can get accustomed to sizing your position relative to your confidence in them, you'll find that in and of itself provides you an edge of profitability. So for every trade you make, weigh and consider your confidence level in it. If you can really hone in on that and size your positions accordingly, you will find it to be extremely helpful. Commandment number 5, always have a stop loss. Now, there are some traders that disagree with this. They think if you have conviction in the play, you shouldn't let your stop loss get in the way. And that could depend on your strategy, but I would highly recommend always having a stop loss. Whether it's actual or mental, just have a point at which you accept defeat. That is an important part of trading. You're going to lose. You need to prepare to lose. Now, if you're a new trader, I wouldn't advise doing a mental stop loss, because that is emotionally challenging, in the beginning at least. It takes a long time to teach yourself to commit to a mental stop loss. But the important thing is that you have one, especially if you're holding trades overnight or swinging them. If you're day trading, maybe I can understand, because you're watching the trade in real time and you can exit whenever you want. But you never know what's going to happen overnight. News hits, something happens, and without the stop loss, you could easily blow up an account, especially if you're leveraged. Stop losses can be difficult for people to accept or implement, just because the idea of acknowledging the potential for defeat is unsettling, or people just want to ignore that. This is why so many people, most people, are not good traders. Acknowledging you got something wrong is never fun, and in trading, that happens the majority of the time. You know, they say if you get 6 or 7 out of 10 trades right, you're a great trader. So you need to come to terms with the fact that you are going to lose many trades, and you need to prepare for it. The best way to do that is to establish a stop loss ahead of time and stay true to it. Is it going to screw you over sometimes? Of course, you're just going to have it dip down, stop you out, and go right back up. As part of the learning process, you'll get better at it over time. But managing risk is one of the most important parts, if not the most important part, of trading. And one of your best tools for doing that is a stop loss. Don't let your ego get in the way. Plan ahead, mitigate your risk, and stay true to your stop loss, because it is helpful and you will thank yourself in the long run. Commandment number 6, cut your losses early and let your winners run. Another important element of trading is recognizing when you're winning and when you're losing. Oftentimes you can see a losing trade right as it starts. You haven't hit your stop loss, but you can tell it's probably going to. So why not cut it off early? Save yourself the extra whatever amount between where it's at and your stop loss instead of just waiting for the inevitable. Now, I wouldn't get too crazy with that because you do want to stick to your plan and sometimes things bounce, but there are times where you will recognize this is a bad play, maybe something changes, I no longer have the same confidence level. Just cut your loss early and look for another trade. Conversely, your winners, when you have them, why not let them go as far as they can? So much money is lost because people exit their trades too early, their winners too early, instead of letting it continue and continue. If you enter a trade and your price target is maybe 10% up and you exit right then, even though the trade still looks good, you could be missing out on a lot of extra profit. Now you want to protect your profits, maybe by moving up your stop loss as the price continues to move in your favor, but let the trend be your friend. If it's going to continue, follow it. There's no reason to exit a winning trade if it's going to continue to be a winner. For a lot of traders, most of their money is made in the crazy winners that they have. You might have an average risk to reward of 1 to 3 or something, but you have these occasional winners that you let ride that get to 1 to 20 or 1 to 30 risk to reward. Those trades can make up for 20, 30 losers. So it's so important to let those ones continue if they're going to. There is a healthy balance between overly managing your trades and just letting them sit and hit your price targets or stop losses, but just keep reanalyzing and reassessing the trade that you're in. If it's moving to your price target and it seems like it still has a lot of strength or momentum, why not just put your stop loss a little bit below where it's at and hope that it continues? You're protecting your capital, but you're also allowing a lot more upside if it continues to move up. Just keep your emotions in check and look to stay in trades that still look good and look to exit trades that are looking bad. It will save you a lot of money. If you have good reason to believe that something is going to continue going down towards your stop loss or continue going up to your price target and beyond, there's no reason to let the rigidity of your stop loss take profit rules prevent you from getting all that extra money or saving all that extra money. After all, the rules are meant to save you or make you the most amount of money, and having the foresight to see when that may or may not happen is incredibly important. Commandment number 7, decrease your position size with every consecutive loss. As a trader, you will have winning streaks and you will have losing streaks. Whether it's based on your plan or your mental state, it's incredibly helpful to mitigate your losses when you're having those losing streaks. If you have 2 losing trades in a row, maybe you're a little off that day. Maybe the markets just aren't suited for your strategy or your mental state. Take a little bit more off the table. If you would normally put down 1,000, cut it in half or do 750. If you lose again, cut it even more. If you lose again, cut it even more. Don't let your bad streaks steal all your money. If you're not in the zone, it's important to have the self-awareness to recognize that and take the necessary precautions to protect your capital. Once you get down to your smallest position size, if you've still been losing consecutive trade after trade, stay at that small position size until you win and then progressively build it back up to your normal position size. You want to trade the most money, the highest position size, when you are having the most winning trades, when you are in the zone, or just when the markets are more in your favor. Everybody knows the markets go through cycles, and your trading isn't really immune to that. You will have ebbs and flows of losses and gains, and when you're in those streaks of losses, you should try to take more and more off the table as you lose. Continuously trading during losing streaks is how so many traders blow up their accounts. People want to trade 24/7. They always want to trade every day. If you're losing, maybe you should just take a break. Come back when the markets are more in your favor or when you're in a better headspace. Losing can have a very strong emotional toll. When traders lose, they frequently have a revenge mentality. They'll want to make that money back, and that can lead to further losses because they're trading emotionally. So just be aware that when you're trading, if you're recognizing that you're having a lot of losses or even all losses in a row, incrementally lower your position size to protect yourself, and then start adding more back in as you become more confident or your trading turns around. And this brings us to commandment number 8. Don't trade to be right. As a trader, you're trading to make money, to be profitable. You shouldn't care if you were right or wrong. You should care if you made money. If you enter a trade going long and it's starting to look bad or like it's going to turn around, you should have no problem immediately switching that trade to short. You're trying to make money. Who cares if it's counter to your original thesis or hypothesis? Something has changed, and now you can make money going the opposite direction. If you have an attachment to the direction of your trade, you're going to be less likely to accept information to the contrary. Markets can change directions quickly, And if you have a long or short bias, you shouldn't let that get in the way of new information coming or the direction changing. This is especially important for longer term trades because you can have some sort of macro thesis or hypothesis that's motivating you to enter and keep you from accepting that it may be wrong when the trade goes the opposite direction. Trading to be right often comes at the expense of trading to be profitable. Our egos are our worst enemy as traders. They constantly misdirect us, they constantly motivate us to make bad decisions, and having a bias to prove you're right that a trade was successful or that it would reach this point is often very counterproductive. Be humble, accept that you're going to have trades, invalidate your beliefs or projections, and go wherever the money is. Being right should always come secondary to being profitable. Commandment number 9, listen to your gut. Now I should add a little bit of a caveat to this because in the beginning, listening to your gut can get you in a lot of trouble. And there is a distinction between listening to your gut and following your emotions. Your gut and intuition is something you develop through hours and hours of studying and trading. It's the little things in the subconscious that surface in a subtle way you can't articulate, but it gives you a feeling that this trade is good or this trade is bad. As you develop that intuition, it's important to follow it. You're not always sure why a trade looks good or why a trade looks bad. And though you should try to stick as best as you can to your plan, listening to your gut as you develop and improve your intuitions will likely help you. If you've put in the work to learn trading and master the markets, you're going to internalize some of that. It may not always be obvious, and it may only bubble in the background and manifest itself through your intuition or your gut feeling. But as you become more and more skilled as a trader, that gut feeling will prove to be a valuable tool. And finding a healthy balance between your gut feelings and your trading plan is going to be difficult and for you to decide. But I believe after you practice trading your plan and develop your skills to such an extent that you are having gut feelings about trades, you shouldn't shun those. You should try to listen to them and polish them even more. Our gut is a lot smarter than people generally give it credit for. And if something is screaming, take this trade or exit this trade, and you can't articulate why, that is something you should take note of and definitely something you shouldn't easily dismiss. As you improve your trading, your gut will increasingly become more and more of your friend. The final commandment is learn from your mistakes. I've alluded to this many times with a lot of the other commandments, but it really is important. If you don't learn from your mistakes, how can you expect to improve? Every mistake you make is an opportunity to get better. You get to see what went wrong, what doesn't work, and add that to your database so you can be better prepared for the future. Learning from your mistakes is how you go from beginning level trader to an expert. It's a long, long road paved with losses and blown accounts, headaches, and emotional roller coasters. But if you continue to learn from your mistakes, you will be trending up in the long term. Consider every losing trade a lesson, kind of like tuition for going to school. You paid to learn something, and hopefully because you paid, that lesson will resonate with you or stick with you much longer. Mistakes are weirdly one of life's greatest gifts. It allows us to improve ourselves, to grow as a species, as individuals, to create a better future, and to develop into the people or traders we want to be. Try to look at every mistake as a blessing disguised. One of the worst things that could happen to you in life is you never make a mistake. How do you learn? How do you feel a need to improve yourself if nothing's ever gone wrong? Nobody is born perfect, and nobody successful got there without serious roadblocks or failures along the way. Learning to not just accept your mistakes, but use them to your advantage, leverage them for the future, is your greatest tool in becoming successful. Don't let mistakes rob you of any more than your money. Get something out of that money they took by identifying the lesson that is to be learned. Our mistakes are just as important as our successes. If you make a bad trade, write down what went wrong. Find out how you could have done it better. Uncover the solutions and use those mistakes to create rules to prevent them happening in the future. If you can find out how to make mistakes a tool, you will truly set yourself up for success in the future. So those are my trading commandments. Number 1, don't overtrade. Number 2, trade with conviction. Number 3, don't follow anyone else's trades. Number 4, size your positions based on your confidence in them. Number 5, always have a stop loss. Number 6, cut your losses early and let your winners run. Number 7, decrease your position size with every consecutive loss. Number 8, don't trade to be right. Number 9, listen to your gut. And number 10, learn from your mistakes. All right, well, that about does it. I really appreciate you listening. And as always, best of luck.